at the Global Mail, and I thought I wanted to share the content of the article with you, just because I thought it was a very informative article. It had some good insights, and honestly, it just provided me with a nice summary of what is going on, where are some of the most richest investors' heads are, and what are they saying. So the article was written by Naomi Rovnick, and the title of the article is Global Investors Eye a Shift Back to China. So just to set the context, the global investors are showing renewed interest in China, driven by Beijing's efforts to reverse the economic slowdown and boost stock markets. So, just a little bit of context, as you know, since COVID, the Chinese market, the stock market has taken a beating. The economy is slowing down. The growth has declined. The consumer confidence is like near all-time lows. So things are not going well in China at all. And it is very concerning. And investors outside of China, for the longest time, they've been saying that, hey, we need the Chinese government to make some policy changes. We need them to be intervening and be active and introduce some measures on the monetary side, on the fiscal side, try to boost confidence, this and that. So eventually, I guess that has started to happen. Last week, the Chinese government and the top officials they came out on back-to-back days and they announced a number of policies. They're saying, okay, they're going to cut interest rates, which was kind of expected because the U.S. also cut interest rates. And then, what was so significant, the next day they also said they're gonna make some fiscal changes. They're gonna try to give economy the boost, not just the economy, give the stock market the boost by injecting some money into the markets. So that's a pretty big news, and the stock market has been rallying ever since. So it is quite interesting that is going on. We don't know if this is just a hype or if this is actually sustainable. And the article dives into that. So the next point here is while a growth boom isn't expected soon, government officials have made Chinese company valuations more attractive. So yes, the economy, which is not growing, is not the same as the stock market, but by taking these actions in the last 2 weeks, the Chinese government has made uh, the Chinese stock market move, and that is drawing in a lot more money. So it's a quick way of changing the sentiment. If you make the stock market go up, maybe even the local consumers, local markets, local companies will also notice, and the sentiment there too may change. So the next point here is early moves in the market. So they interviewed like an official from an investment firm, and by the way, this investment firm it was a hedge fund. So even the last two rallies, it has mostly been driven by hedge funds, and not exactly institutional investors. So, investment firms managing over $1.5 trillion dollars are cautiously optimistic about China. So that's the feedback they got from this particular investment firm. Gabriel Sachs from ABRDN, he said more upside than downside despite selective investments and waiting for more policy details. So he is cautiously optimistic, and he thinks yeah, the risk to reward ratio is in investors' favor, and yet he will still wait for more signals from Chinese government. And just as a reminder to everyone that the recent support from Beijing has led to a sharp stock market rally. So that's something, he reminded everyone. So when it comes to the economic outlook, we have the challenges which we know about, but they are listed here. Factory activity shrank for 5 consecutive months. That's serious. The China is they call it the manufacturing of the world. So if factory activity is shrinking, chances that they're not producing as much, chances that people are not working as much. Yeah, it just shows that the whole economy is weak in China, but maybe even globally. Anyways, services sectors slow sharply in September, so it's not just manufacturing. Services have also gone down, and this was in September, so just recently. So that's a pretty big deal. So you can see that even like 3 years, 4 years after COVID, mm, it's getting worse. The economy is getting worse in China. Beijing's urgent need to meet its 5% growth target for 2024. Yes, the target of 5% growth, they're not going to meet that. And perhaps that's one of the reasons why they are making such announcements, lowering interest rates so that it's easier to get a loan and less riskier. So, I guess with the year end coming up, they are still trying to meet that target, but chances are they will not be able to. Next is so some of the key moves that they've made. They have eased home buying restrictions. That's really good considering that China has a serious housing meltdown happening there. Uh, Cut banking lending rates. So again, that's not just going to help the housing, but it's also going to help businesses. That's always the first step banks do when you're going to a recession. And provide cheap funds to brokers. So that's a big deal. This is the fiscal policy I was talking about. We need they need funds and they need to inject to stimulate the markets. So out of the three, I would say all three of these policy changes are big, but the last one is probably one of the biggest that caused the stock market to go up. Next item is that investors are cautiously optimistic. Hedge funds led recent stock surges. Long-term investors remain cautious. So this is something I mentioned. Yes, this run-up has been mainly led by hedge funds. So the hedge funds are kind of traders, so just keep an eye out for that. Mutual fund holdings of Chinese stocks dropped to decades low. So that is still true. Mutual funds, long-term investors, that number is still low. Investors are more confident after recent government pledges to meet growth targets and support consumer spending. So same thing, I think confidence has increased, and that's very important in the stock market. Risks and opportunities. So property crisis and US-China tensions still pose challenges. That's very obvious. Some investors like Artemis fund managers have increased their Chinese equity holdings. So that's fantastic. So you can see that some fund managers are increasing their Chinese equity holdings. Then we have an analyst or investor from Fidelity, Mr. Avstatopoulos. He said rally is liquidity driven and short-term moves may not last. So he's just saying, hey, be careful. Be careful. Liquidity, people are buying this stock and liquidity can dry up anytime. Okay, what about the long-term outlook? The long-term outlook, investors are divided. Many await improvements in Chinese consumer confidence before making larger moves. So that's something very important. Actually, I want to like highlight this and I want to keep an eye on this. I want to find out, how often the Chinese consumer confidence is measured and on what days, what weeks is it released. So something, I want to keep an eye on. Uh, because if we see that there's a change here, more investors will jump in. Okay, Mark Tinker, he stated that Beijing's measures aim for sustainable growth, not just quick gains from property or infrastructure. Yes, so it's good. He's saying that China, they're trying to have sustainable growth and they're not looking for a quick recovery. So that in the long term, everything is stable, sustainable. There's no bubble. There's no bad allocation of money, bad allocation of capital. They don't want that. So that makes sense. I know, like in some countries, like the American Feds, they're always criticized for, intervening too hard and not really, rooting out the problem and just kicking the can down the road and all that stuff. Conclusion. So though the risk remains, investors are watching closely as China makes key economic policy adjustments. Positive sentiment is growing as the US rate cuts might boost global demand and support Chinese exports. Yes, yes, that's very true. That's a pretty good point. Investor allocations to China is expected to rise slowly in the coming months. So hey, like honestly, things are looking positive for China and Chinese stocks. And Alibaba is it's going to be one of the main beneficiaries. Key codes. If you have nothing in China, you may want to add some positions. Luca Paolini from Pictet Asset Management said that. And then Noel O'Halloran from KBI Global Investors said, too early for many to change allocations, but direction is up. So overall, like everyone is saying, honestly, most people here are saying that, yeah, like we're near the bottom and we are at the bottom and you can only go up. So and you know the theme of this is that yeah, the Chinese government they want the economy to do better and they're finally taking steps to make that happen. And it looks like that was the missing piece. Now that they're doing it, investors, they have more confidence, their confidence building, and eventually more and more investors will start jumping in and buying Chinese stocks again. All right, that's it for me. Until next time, goodbye, everybody.